most of ECP's history, we've been acquiring existing assets for a substantial discount to replacement cost. That's because markets have been oversupplied and power prices have been low. Even if it was possible to build a new asset next to the one you own, it was largely too expensive to do so. Less of our time was focused on the value of that optionality or organic sort of growth. And today, that's really changed. That can be a really meaningful and exciting part of an existing investment, or it's great because it's kind of found money a little bit, or it can be a big part of the investment case for new investments.
Hello and welcome to Cool Vector. I'm David Snow, your host. And today we're joined by Andrew Gilbert. He's a partner at Energy Capital Partners, ECP. This is a major investor in the energy transition. It specializes in electricity and sustainable infrastructure. It has raised more than $32 billion in capital commitments since 2005. And as most people in the digital infrastructure world know, it is a major partner to the data center industry. So, Andrew, thank you for joining Cool Vector today. I can't wait to talk to you.
David, thank you very much for having me.
Let's start at a 1,000-foot level. You are supplying electricity to data centers, among other things. Have you ever seen demand for power similar to what you are seeing coming out of the data center industry before?
I think, David, that's an easy question. The answer is no. ECP has been around for 20 years, and in that time, power demand across the country has been flat. There have been pockets, places like Texas, and times here and there where there's been some differences. But on the whole, the CAGR for electricity demand across the U.S. has basically been zero for 25 years. And now that's very much changing.
If we could use a baseball analogy, where would you say that the market is, the world is, as far as energy necessary for the digital infrastructure build out? First inning, second inning, somewhere else?
That's a difficult question to answer. Despite all the announcements over the last year or two, the vast majority of data centers across the country are still pretty small, certainly under 100 megawatts, many of them 10, 20, 30 megawatt type data centers. Just a few years ago, that was a big site, a big location. And today, even the largest data centers across the US are probably in the 100 to 300 type range. There are probably not 20 data centers that are over 100 megawatts today. And when you compare that to some of the recent announcements of much, much larger sites, I think all indications point to we're still in early innings here. The larger sites now being announced are gigawatt plus type locations, are multiples what the largest installed facilities are today. So it certainly seems like we're at least in the first half of the game. And if you look at the announcements from some of the larger tech companies out there, their capital investments continue to increase.
What kinds of phone calls is ECP getting these days? There's a need for compute, or rather a perceived need for compute as soon as possible. And then, of course, with compute, you need massive amounts of energy. So then the phone rings at ECP. What are your partners or proposed partners asking you?
We're hearing about connecting to existing assets. So can we locate a data center on or adjacent to a power plant that you own in the portfolio? We own a company that produces gas turbines, and there we're having data centers and other customers ask directly about equipment purchases and make them in some cases. And then importantly, and maybe less talked about these days, is non-technology, non-data center customers are also interested in procuring electricity in ways that they weren't just a couple of years ago. Prices, as you know, have gone up a lot, and that's caused many users of electricity, again, not just data centers, to be worried about security of supply and cost of supply. So even just large retailers serving residential customers are calling in ways that they weren't before and are interested in longer term contracts. And large industrial users of electricity are calling as well. Utilities too, where historically, I think they were very comfortable passing along wholesale rates to customers in deregulated markets, are now a lot more concerned about price volatility and escalation, and so are trying to reduce that through hedges or PPAs.
Can you talk about the amount of energy needed for some of these data center projects? There have been projects announced that have $20 billion, $50 billion price tags on them. When ECP thinks about partnering with a project of that size and scale, what gets you excited? What gets you nervous? What's different about addressing something of that magnitude?
Yeah, I think what's challenging about some of these sites, some of the larger sites and newer sites, is the cost of new generation and the length of commitments from off-takers. In many cases, the larger data centers are still connected to the grid. They're still relying considerably on the grid. And they're doing so in part because that remains, despite all the challenges, much more affordable than building entirely new capacity to serve a data center. And while the companies, I think, are increasingly willing to lengthen commitments through their contracts, that usually means 10 to 15 year type commitments. And they are building or requiring, in some cases, to build 30, 40 year type assets. And so there's certainly a mismatch there. And it means it can be handled through price or incremental risk taking on behalf of investors like us. Where it's easiest, maybe today, in terms of the economics or financial part of the deal, is with existing generation. The capital cost is already there, and all a customer sort of has to do is beat the market price, whether through price, absolute price, certainty, or tenor, or some combination of the three. And that's a lot easier than providing the support required to build a new gas facility, for example, which today is a lot more expensive than it was just a couple of years ago.
Are there any cases where a potential partner calls you, kind of spells out the project they have in mind, and you have to tell them that you don't think it's going to work or you're not the right partner? What would be some attributes of a project that would make you say no?
The places we see conversations break down most often are unreasonable timelines to electrical service, difficulty of getting gas to a site, or the length of a contract can be part of it. Today, while there are bigger, newer sites being announced, we're seeing a lot of interest in kind of finding capacity in the grid still, again, for affordability reasons, I think, and for speed to service reasons. I think that still is, in most cases, the fastest way to get a project connected. And so something totally new, kind of from scratch, building all your own generation is 5 years out probably today. And so it's a little tougher to get traction on something like that in the market today.
You mentioned unreasonable timelines. Is it safe to say that a lot of groups that you are talking to want power ASAP? They want it yesterday.
Yesterday. Yep.
And so what are those conversations like? And do you think that when they discover the amount of time it's going to take to get the amount of power that they need, they have to rethink their plans?
Yes, absolutely, David. But I think they already have. I think a year and a half ago, we had a number of conversations that would start with, we want to talk about 5 gigawatt sites, existing sites. And our reaction was, well, there are only like 1 or 2 of those across the US. we don't own them. And for a bunch of reasons, it's probably not the right place to put a data center. The customers, I think, have quickly become very sophisticated. They are more realistic, but they are, I think, trying to keep as many balls in the air as possible and to prioritize the projects that are faster. There's surely a project out there, even today, that can get electrical service in 2026. And I think those customers are going to do everything they can to find that project and prioritize it above all others. And so I think that's a lot of what we're seeing. It's also part of the reason that many interconnection queues are overstated in terms of how much demand there is for these projects. Because if you need 500 megawatts in 2027, you're going to pursue a number of different sites in the same region or in other regions to make sure you do get a project that works. And today there are limited costs or risks associated with doing that. So these companies, I think, are sort of incentivized to create as many options as they can.
ECP has been in the energy business for 20 years as an investment firm. What advantages does ECP have as a partner to digital infrastructure providers?
Yeah, I think it starts probably with the existing footprint of assets. So much of this is about speed to market. And so if you're already generating electricity somewhere, that in most cases is going to be the fastest place to continue to do that. I think knowledge of the markets in which we operate is helpful as well, whether it's utility tariffs or interconnection processes or so on. I mentioned we also have a business that can actually manufacture equipment for these sites. That helps in a supply chain constrained environment today too. So I think it's all those factors.
As ECP has met this surge of demand for electricity and for the kinds of expertise that you have, has it had to beef up any particular parts of its business? Have you invested more in the construction and development side? Have you brought on board certain types of people?
Largely, I think I would say it's just a lot more time and effort being spent around the optionality of sites that we own or new sites that we look at. For most of ECP's history, we've been acquiring existing assets for a substantial discount to replacement cost. That's because markets have been oversupplied and power prices have been low. Even if it was possible to build a new asset next to the one you own, it was largely too expensive to do so. So less of our time was focused on the value of that optionality or organic sort of growth. And today, that's really changed. That can be a really meaningful and exciting part of an existing investment, or it's great because it's kind of found money a little bit, or it can be a big part of the investment case for new investments. It is still work in progress for us. And we've got, longstanding relationships with a number of folks who have done different forms of power development historically. And so we've leaned on those people and relationships. But it is new for us too, thinking about investments that way and pricing them. It's a work in progress for us.
Let's talk about renewable energy. There is a hope from many parts of the world that the build out of digital infrastructure will be an influence on the greater adoption and greater investment in renewable energy. A lot of that comes from the mandates of the hyperscalers themselves, the desire to reduce or completely eliminate their carbon footprint with regard to digital infrastructure. How would you characterize the current uptake of renewable energy across digital infrastructure? Some people have said it's a little bit on hold as everybody races to get to market as fast as possible. And they say, geez, it's going to be a lot easier to use natural gas than to do this with wind and solar. How would you characterize just the state of renewables and where do you see it going within digital infrastructure?
Well, it's certainly been a volatile environment for the renewable space. If you just looked at the public companies in the renewable space versus the independent power producing groups of the Constellations and Vistras of the world, their stock price charts in the last year or two are kind of in opposite directions. There are some good reasons for that. Of course, the policy risks that the industry's been facing, but both types of companies generate electricity at the end of the day, and electrons don't care where it comes from. The themes that are driving higher power prices should benefit the renewable industry and will benefit the renewable industry longer term. And while I think the hyperscalers have very much prioritized getting power to build AI, to serve their cloud customers and so on, and that needs to be reliable power, they remain the largest off-takers of renewable energy. I think there's probably more flexibility, or there's had to be, on the behalf of those companies because, in their view, the urgency of this opportunity or need that they have, but they continue to demonstrate a willingness and ability to pay for the renewable attributes of solar, storage, and to a lesser extent, wind. And we expect they'll continue to. And then further, I think what's really changing, and maybe the most positive thing for this industry, is that 3 years ago, most of the renewable megawatts getting built were getting built for the green attributes alone. Power markets were largely oversupplied, so the electricity arguably wasn't really needed, or not in the way it is today. And these things were getting built or contracted at material premiums to wholesale power prices. Today, a lot of that has changed. I think most of the country needs or will need all the megawatt hours it can get in the near term here. And solar is certainly the cheapest form of electricity, absolutely with the tax credit, and even without it is cheaper on a simple dollar per megawatt hour basis than new gas, because gas has become so expensive. And while it's a different resource, it's obviously intermittent and not dispatchable, there is still a material cost advantage there. We believe economics will win eventually, and that should be a real benefit, I think, to the renewable industry.
Excellent. Can we talk a bit about an investment that was announced recently by ECP in Bosque County? Talk a bit about what was unique about that investment, and do you think that'll be a template for further similar projects?
We absolutely do. This investment we announced with our partner, KKR, it is located adjacent to an existing Calpine power plant, what is now called the Thad Hill Energy Center. We, ECP, have been the control owners of Calpine for 7 or 8 years now. And many of the existing sites across the portfolio do have space and potential to add load, whether behind the meter or otherwise. The background of the story is interesting in that several years ago, we had a number of crypto mining operations contact us about power demand and potentially locating adjacent to or at our sites. And that sort of started our thinking around permitting and planning and engineering for this type of project. That ultimately didn't happen, but then shortly thereafter, data centers came around and we're interested in the opportunity for similar reasons. Examples like this are the fastest ways for new large data centers to get built. The transmission infrastructure around existing plants is typically more robust. That makes it easier and less expensive for utilities to connect projects. I can't get into all the specifics, but we and the customer here have negotiated terms which do provide for some load flexibility, therefore not putting the rest of the grid and the average customer at risk during certain grid conditions. We think that's increasingly important in Texas and across the US. So yes, David, absolutely. We think there'll be a lot more projects like this. And as I mentioned, we did this as part of our partnership with KKR and its portfolio, CyrusOne, who's constructing the project.
For people who may be less steeped in energy grid technology, what is load balancing and why is that an important step forward for the way that a data center might structure a relationship with an energy provider?
Maybe to start with just how power markets have traditionally worked or how utility tariffs have kind of worked. You can almost think about it as every customer gets a pretty similar service. And traditionally, you would show up to the utility and say, hey, I'm a homeowner that needs 10 or 20 kilowatts, or I'm a large consumer that needs a megawatt of energy, whatever it is. And the utility would sort of give you your rate and then would build the required infrastructure to serve it. And the cost of that required infrastructure would be more or less ratably shared across the whole set of customers. And that all kind of works if the customers are of similar size. And I'm oversimplifying too. There are certainly rates for bigger customers and smaller and different risks. But all of a sudden, when you have certain markets where a couple of new data centers can represent a huge percentage of the existing load, it can materially increase the cost of that infrastructure, or it can materially increase the risk of an outage or constraint of some sort. And so what that's meant is a fear that either data centers are going to cause electricity rates to blow through affordability levels or cause the lights to go out under certain conditions. And so that's a process kind of everybody in this industry is working through right now. And the ways to kind of address it are backup generation at the data center site, such that if the grid reaches certain levels of constraint or emergency, that backup generation is used or the facility curtails or other kind of demand responsive type actions. Another more on the affordability side is simply a different rate for bigger customers through various mechanisms, whether it's a longer term commitment or a higher price or sharing of the infrastructure spend. And that's something too that's starting to be a part of this in certain markets and we think will continue to be. But I don't think the customers nor the suppliers or really anyone involved wants a situation where there's a greater risk of an outage or you have the power go out for a bunch of customers while data centers are running, right? That's not the answer folks want, nor do utilities want to serve smaller residential customers and otherwise a much, much higher rate because down the street, a couple of data centers are being built by really large, well-capitalized companies.
So in practical terms, if there were a sort of surge in use in a certain location on a certain grid, would the data centers power down for a certain amount of time and then power back up? And is that quite a different policy from the past?
Yeah, I think their position, given how their processes work and some of this, especially the traditional data center load is very latency focused. And if you think you're doing your online shopping and you're getting to the shopping cart, they want that response to be quick so that you don't change your mind or whatever it is, that the speed of delivery of the content has been really, really important. Perhaps for certain training loads and other things, it's less important. And so maybe there is more load flexibility as as you described, David. But in a lot of cases, we've heard not so much. And instead, it's about the customers, the data centers themselves, building backup generation that can be used during those times, but they can build it at their cost and use it in the rare circumstance where it's actually needed. And so the grid doesn't have to bear the cost or the risk of that continued usage. Instead, the location itself picks it up.
Just briefly, what typically is the source of the backup generation?
Yeah, well, traditionally, it's been reciprocating engines that have been run on liquid fuel or fuel oil. That's part of the issue is the emissions associated with those machines. Often the permits are pretty limiting in terms of how often they can be run for good reasons. But increasingly, as these sites get larger, that potentially could change. And there could be more natural gas. There could be more efficient facilities built as backup. But it comes with the customers, I think, accepting and realizing that the generation might be there for more than a 1 in 20 year type event. Like it could be something that is used a couple times a year. And that's really a different build case. Once the sort of deliverability of firm electricity is getting scarcer, it's more likely that it will be a little bit interruptible, meaning that if my only option is to take some chance that once a year I have to turn off or not get connected at all, I'm probably going to deal with that risk or price it in some way. And we're just starting to see that, I think. But historically, these companies have been able to contract for very firm service and haven't really been forced into that. And in fairness, they've paid for it, I think, in many cases as well.
What types of partners, what kinds of projects is ECP looking for? If someone is thinking of a certain type of digital infrastructure project that has certain requirements, in what cases should they pick up the phone and give you a call?
I think certainly, as I mentioned, the easiest places are probably close to assets we already own. I think those are the most affordable solutions and the fastest to grid. And so best for customers and easiest for us to get done. We want to work with people who are realistic and reasonable, and we're happy to take on complex problems with those who are. For us, that's the opportunity to build new capacity to serve new demand is really exciting. I think one of the things that we can bring is willingness and ability to take risk. Unlike utilities and fully regulated models where you rely on customers to provide certainty through a regulated rate of return, we might be willing to build a 30-year asset with a shorter contract in the right market for the right conditions. And that should make us more competitive versus other options, we hope. It is interesting. Many of our investors are not just invested in ECP, but other competitors of ours in the infrastructure space. And the digital space has grown tremendously. And so it's still a minority of our investors, but I think some of them are starting to worry about concentration across digital because so many investments have been really, really successful, which is great. But it also means the portfolio allocation or portfolio balance has been thrown off by that. And so some of them have mentioned that as a growing and new concern.
As a professional investor, what makes you excited to be part of the digital infrastructure power project going forward? When you meet friends, you're at a backyard barbecue, whatever. What are you talking about?
Yeah, well, I think it's a great question because for years, I think people felt as though this was about as boring a space in which to invest as any. Not too many people were worried about electricity or power, but all of a sudden it's in the headlines and in the news every day. And many people are asking about it. And some, of course, are asking you about it for the wrong reasons and want to blame you for higher electricity prices. But no, it's really exciting to be part of a growth industry again, which really hasn't been the case. Renewables a little bit, but overall for the power industry has not been the case in ECP's history. And so that and feeling like we ECP can play a small part in our country's pursuit of AI and the economic benefits of that, I think is really exciting. And so it's definitely become a much more exciting and topical space in which to work over the last couple of years.
When you and your partners at ECP are, just talking about the future generally, maybe spitballing, maybe speculating, where do you think data centers can go? We know that there's probably quantum computing coming. There's all kinds of different things that are coming down the road that could further expand the demand for compute. So when you're talking about the future, whether it's 5, 10, 15, 20 years out, what do you think is possible?
Great question. I think we're debating quite often here. So much of the debate and rhetoric or headlines are about artificial intelligence and the demand specific to that. Remarkably, that's still, I think, a minority of the overall usage of power for compute. Most of it is still enterprise cloud type support. And even though maybe there's more of a gray area across data centers these days, I still think that that's true. And I think it probably will remain true for the next couple of years. And then still further, training is the vast majority, I think, of artificial intelligence related compute too. And so we still don't really know what the inference need might be. And there's a lot of debate on, will that be larger or greater than training load? And I think there's a long way to go, but we're still really in the learning phase. And you see companies like OpenAI or Microsoft talking about whether it's queries or tokens processed going up 10 times or more in less than a year. And I think that's before you're starting to really get into video and some of the other things that you mentioned. So it's a great question. I think a lot of forecasts have demands requiring something like another 75 to 100 gigawatts between now and 2030 or so. I think it's hard to imagine that much infrastructure getting built in that timeline. It's hard to estimate. We're certainly seeing a lot of financial commitments that would support numbers getting close to that range. Industry projections have numbers like 75 to 100 gigawatts of data center load being added between now and 2030 or so. And sure, there's probably some existing capacity you can use across the US, but markets are pretty constrained for the most part today. So it would require more than half those numbers, I think, of new capacity. I think it's difficult to see that getting built. But even if you look at the numbers that PJM or ERCOT puts out there, they certainly show supply gaps in that 40 gigawatt range in that same sort of timeline. They, of course, are making those estimates based on the best information they have. And so it gets back to kind of duplicity or redundancy of load requests. But still, it definitely points to a major need across many U.S. markets.
As the market and ECP attempt to respond to the amount of demand that is coming down the pike and to build the infrastructure necessary, is there a key scarcity that will delay or prevent the full demand from getting built out? Is it labor? Is it a certain type of component? Is it the supply chain? If you could predict something that kind of throws a monkey wrench into the whole thing, what would that scarcity be?
I think labor is a big piece of it. We're seeing EPC costs for all types of projects go up tremendously. When you think about this theme, data centers, related power infrastructure required, LNG as well, potential large in manufacturing and investment in semiconductor facilities and otherwise. The firms building the stuff are charging more for it, and that's kind of driving costs up. And then the gas turbine manufacturing business has been really constrained. OEMs that have traditionally done that probably had production capacity about half of what it was 10 years ago when this all kind of started. And certainly they're making investments and trying to ramp that capacity up. But those companies largely have pretty global supply chains. And so they don't control all of it. And it makes it a little bit harder to ramp up as quickly as they'd like. Those two things certainly will be major constraints. Permitting as well, that remains a huge challenge across the country. Building new natural gas lines to serve natural gas facilities that gas ultimately, whether directly or indirectly, is going to be the biggest source of powering all this stuff in the next few years. And we have a gas infrastructure constraint problem already across the country. Many companies are responding to that quickly, but pipeline projects take a long time to get built.
Excellent. Well, Andrew Gilbert from ECP, I've got a lot more questions for you, but I think we can pause for now. I really appreciate your speaking with Cool Vector, and I hope we can have you back in the future.
Great. Thanks, David. It's been a pleasure. Thank you very much.